Hi there, Happy New Year, and welcome to the January edition of CUNA's Economic Update, a monthly video review of economic developments and how they affect credit unions. I'm CUNA Chief Economist Mike Schenk, and I want to talk to you about three key items today. Before I do that, I just want to shout out to Co-op Financial Services for their generous support of these efforts. They're our new sponsor, and we thank them for their cooperation and collaboration and look forward to a long and fruitful partnership on this front. So, having said that, I just want to talk to you real quickly about three things: then and now, hits and misses, and a big strategic mistake. When I sat down to put this presentation together, I thought to myself, gosh, it's been a while since I've done an economic update. Actually, it was before the holidays. So I thought I'd look back at the deck that I used before the holidays and compare the themes, the key themes from that deck to what we see today, how things have changed over the interim and why that matters. Second thing I want to do is just talk for a minute or two about hits and misses. These are economic indicators where the results that have been announced during the month of January differ or really align with what economist expectations were. And then the third thing I want to talk about is, given these developments, one of the things that I'm really concerned about from the standpoint of how credit unions behave in the marketplace and what they might do better going forward in the current environment to not only improve their operations, but improve their interactions with policymakers and improve their communities. So those are the three big things. So first, then and now. Our starting point throughout the pandemic on any economic update has been this graphic. A month ago, in the middle of December, I was presenting this data, which basically showed, and this is obviously regional data for Northeast, Midwest, South, and West. This basically showed from this vantage point that we were near peak from the standpoint of the pandemic almost everywhere we looked. And again, I could slice this data in various ways and essentially come up with this very same conclusion. Again, whether it was hospitalizations or admittance to ICU units and all of those sorts of measures were basically reflecting this kind of spike. And of course, that created a lot of consternation and a lot of concern around the idea that this was going to have a real negative effect on economic interactions, economic activity generally, and by extension, within the realm of credit union operations. So that was then. This is now. Now we don't see a peak and basically an increase everywhere we look. We see almost the exact opposite. We are off peak, obviously, just about any way you slice this data, and we're trending down almost everywhere. And that's good news. It bodes well for economic activity as we look forward. Now, a couple of things to keep in mind. Number one, the widespread availability of vaccines is very important to keep these trends going. And the effectiveness of those vaccines is likewise very, very important to keep these trends going in the right direction and offer us the hope of an economy that's more smoothly functioning and functioning more normally as we go forward. We don't know, health professionals don't know, if the COVID variants that we're seeing today will be effectively combated with the virus vaccines that we currently have. And that remains to be seen. I don't have a guess on that. I don't think most healthcare professionals have a guess on that. It concerns us. But generally speaking, when we look at the same data today that we looked at back in December, it's overall very, very hopeful in terms of what the future looks like. A second thing that I was really concerned about and spent a lot of time talking about back in December was this number. This was the number that was basically my running total of additional federal fiscal support that was pumped into the economy after the CARES Act and several other initiatives earlier in 2020. Then there was a lot of talk, as you may recall, about additional stimulus, and it never seemed to come. The prospect of it coming in 2020 actually seemed pretty dim, even when I was presenting in the middle of December. Again, there were some really significant concerns associated with this. In general, the data that we were seeing, and here's an example from the Census Bureau, the data that we were seeing basically made it very clear that millions and millions of Americans would be unable to pay their bills if there wasn't additional fiscal stimulus in the near future. It wasn't just in the consumer sector, we also saw it in the business sector as well. 75% of businesses are run by fewer than 10 full-time equivalent employees. They generally have weak balance sheets, weak income statements, and they just don't have the flexibility to weather through an extended crisis like the one we're in without help. And in the middle of December, it was clear without additional help. This is the other thing that really complicated things in the middle of December. Where I live, outdoor dining looks like this. It ain't happening. And so, of course, the weather outside, as I look outside today, looks very similar to this, and is going to be this way for a couple more months. So aside from what's happening with the pandemic, we really do have concerns about these small businesses that are being magnified in the middle of the pandemic because of the average consumer's inability to interact with these businesses, again, across a wide swath of the US economy. So those are things that really concerned us a lot then. Now, of course, things have changed and changed dramatically. At the end of December, the Congress passed and President Trump signed a Consolidated Appropriations Act of 2021 and essentially pumped nearly $900 billion more into the economy to get people and businesses through the crisis faster and with less disruption than otherwise would have been the case. And that was great news. Of course, the other part of this is that now, with a new administration in the unified Congress, we have executive orders that help in other ways. Help with food security, for example, by expanding the SNAP program. And the prospect of an additional nearly $2 trillion in fiscal aid in the near term, again, to help people get through and help businesses get through. That's great news in the short run. Bodes well, again, for economic activity in the short run. It does present challenges over the longer term and some for credit unions. But again, getting us through is the main concern at the moment. And all of these developments just in the course of the last month are very, very helpful. There are a few things that we're still very concerned about. And the job market is one that we hit on almost constantly, not surprisingly, again, over the course of the pandemic and the downturn, and especially because the job market downturn was especially nasty this time around. Now, this is a graphic that shows, you're probably familiar with it if you've seen me talk in the past, a graphic that shows job market declines and recoveries over many, many recessions historically. The purple line here shows overall job market performance in the current crisis, and it's essentially telling you that we lost about 15% of the jobs by April that were outstanding pre-pandemic. So comparing February to April, 15% of jobs nationwide essentially went away, at least for a short period of time. And you could see a fairly significant bounce back, again, in a short period of time, as economies open from this decline of nearly 15% to, at the end of November, being down about 6.5% overall in terms of total non-farm employment. Of course, the effects were not uniform, and that's what the black dotted line here shows. This is the performance of the leisure and hospitality sector, so that would be restaurants and things like hotels and amusement parks and that sort of thing. Over 10 million folks employed in that arena, and half of them lost their jobs in the first couple of months of the economic downturn. Again, there was a dramatic and a fast improvement in terms of the employment outlook for folks in that arena. But still, at the end of November, those jobs were down 20% overall. The 6.4%, I should mention, is a figure that actually is lower than the depths of the Great Recession, when the job market declined at most 6%. You can see it took a long time for those jobs to come back in the wake of the Great Recession. And in fact, the three longest job market recoveries are in the three previous recessions to the one that we're in today. So that concerns us a lot. And this is now. We've seen not an improvement in this data, but an actual erosion in the data. Again, it's a reflection of the fact that in November we were peaking, and then also the weather changed and changed pretty dramatically across a big part of the country. So at the moment, the most current data that we have for the month of December, data that was released in the first week of January, shows that the job market is not 6.4% down, but 6.5% down overall. And in the leisure and hospitality industry, for example, the decline is not sitting at 20% any longer. It's actually more severe, over 23%. One of the most important hits that I saw was the inflation data. Came out from the Bureau of Labor Statistics on the 13th of January. Consensus forecast was for inflation to come in at 0.4% in the month of December. And in fact, when BLS released this data, the increase was 0.4%. So we hit that right on. This is a really important metric, as you know, because it has a lot to do with how the Federal Reserve views economic activity and their role in terms of monetary policy. And essentially, that data is showing us over the course of the full year that inflation increased at a rate of 1.3%. The Federal Reserve is not going to move. If you like where the federal funds rate is today, you're going to like where it is next month. You're going to like where it is the month after that. And I'll bet you're going to like where it is next year. It isn't going to move over a fairly long period of time. And this is the data that essentially proves that out. Actually, as I record this, I reflect back to a news release that I saw earlier this morning when the Fed came out and essentially said, you know, the economy is pretty weak and inflation is pretty low. And so we're going to stay on the sidelines. So this was a really significant hit. Of course, it has implications for credit union earnings. It essentially suggests that funding costs will not change very much going forward. And I believe there is a prospect as the economy improves for long rates to increase a bit. And that means, if we're right, that means that it's likely that credit union spreads will be increasing over the course of not just the next couple of months, but probably for a good part of our forecast horizon. We don't think it's going to be a dramatic increase, but it will be a meaningful increase and be more than likely helpful because we all also expect, for example, mortgage refinancing activity to drop off pretty significantly. The big miss that I saw in January had to do with business confidence, and it's probably not all surprising in retrospect when you think back to the outdoor dining picture that I showed you earlier. This is the National Federation of Independent Businesses Small Business Confidence Index, released on January 12th. The consensus expectation amongst economists was that this number would come in at about 100. It actually declined significantly lower than 100 to 95.5. And you can see from a near-term historical perspective, 95.5 is just a hair above the May reading of 94.4 and a couple ticks above what we saw in April in the depths of the pandemic, or at least the initial reaction to the pandemic or overreaction to the pandemic, however you want to look at it, when people were extremely concerned about the future and extremely concerned about their ability to weather the storm, especially again early in April, in the absence of any federal fiscal stimulus or help of any kind. So in November, we were looking again at this situation where things were going to get tight, a spike in the virus, and not a lot of help from a federal fiscal standpoint. And that had a lot of businesses, small businesses worried. That matters, of course, not simply for credit unions that serve businesses, especially small mom and pop independent businesses, but it also matters a lot to credit unions that don't serve businesses because their members are employed by these businesses. So those are two that I thought would be really worthwhile to think about in terms of what's going on in your neck of the woods and going forward, what to expect. A strategic mistake, I just want to talk about for a brief moment, that job market data that I showed you earlier, and suggest to you that like a lot of things with the pandemic, the developments that we're seeing have basically magnified and accelerated trends that we have been talking about for a long time. And in particular, the one that we're very, very concerned about has to do with both wealth inequality and income inequality those trends have been visible for many, many years, and they have accelerated and been magnified during the current crisis. And we think that's going to be a very big deal, especially with the new administration and a unified Congress and new people sitting in regulatory bodies where they're going to care a lot about this trend. They did care a lot about this trend historically, and now it's more pronounced. According to the Financial Health Network, we have 170 million Americans, about 67% of people are at the moment financially unwell. And the data that we have from the Financial Health Network collected in July, so right after the beginning of the pandemic, essentially shows that the disparities that we have seen over time by gender, by income, and by race and ethnicity have either held steady in the case of gender or have actually increased dramatically in the case of both income and race and ethnicity. It is impactful that if you earn less than $30,000 in the United States, only 10% of those folks are essentially financially healthy at the moment. 89% are unhealthy. At the other end of the spectrum, the number's a lot lower, but even those making more than 100,000 a year, 39% of those, according to the Financial Health Network's measure, are financially unhealthy. That's a really big deal. And so from a strategic standpoint, what I want to make abundantly clear is that credit unions have really done a great job in the pandemic. And we need to do more actually going forward. That's abundantly clear in the data that we're looking at. But the other thing is, and I think the strategic part of this that becomes more obvious anytime you have a conversation with a policymaker is A, that they're focused on this, and B, that they want to hear more from you about what you are doing to help soften the blow in this arena. So we, in my opinion, spend a lot of time as a movement talking about the good things that we do, but probably not enough time. And it's certainly clear in the current environment, again, from the conversations I've had with policymakers, that going forward, just talking about the good things you do and the stories that we have will not be enough to move the needle from a policy perspective. If you care about your ability to interact with members, if you care about your ability to sidestep onerous regulations that actually increase friction in that relationship with your members, then you have to care about being able to prove from a not simply the standpoint of stories, but also from a data-based standpoint, being able to prove that you're doing something to improve the financial well-being for all in your field of membership. So this is a huge opportunity for credit unions, in my view, a huge strategic opportunity to differentiate ourselves from the banks. I think we should seize that opportunity. I would urge you to do that. And I warn you right now that if we don't seize that opportunity, that's going to be a tough road to hoe from a policy perspective going forward. So that's the economic update for January. Hope to see you again next month. And again, thanks so much to Co-op Financial Services for sponsoring this effort. See you next month.